And because of this feature, there's something unusual that happens with Bitcoin, which is that when price goes up, volatility goes up with it. This is a key insight because most assets do not behave like this. When the S&P goes up, volatility actually kind of may come down because the market might anticipate it's overshot and we have to come back in. And so the fixed strikes and the vol surface doesn't really move that dynamically. But in Bitcoin, it does. And so what you have here is a double whammy effect of not only do the dealers have to now buy more than their models would have told you, once you put in the higher implied vol number, the models now tell you you have to buy even more than what your books marked it for yesterday. And that creates an incredibly compounded squeeze to the effect that you have seen in certain stocks in the past, like GameStop and AMC, et cetera. Now, and I think this is, yeah, go ahead.
Jeff, I was going to say, so you mentioned GameStop and some of these other stocks. One of the things that I think you were talking about, I'd love you to explain, is when we have seen these gamma squeezes or whatever kind of vernacular people want to use, these are companies that have equity, that they can issue more equity. And so they can kind of tamper it down. I liken it to, the fish are trying to eat, you feed the fish, they stop trying to eat, right? They're full. You can't issue more Bitcoin. And so how does that play into this?
Right. This is the beautiful thing about the monetary design of Bitcoin as the fundamental core ethos.